It's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, and 3 a.m. in Sydney, 10:30 at night in Mumbai, and 10 a.m. in San Francisco. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world. My name is Patrick L. Young. The IPO-VID Livestream Series 3, Episode 4, this is number 16, starts here. After the recent failure of preparation, Washington, D.C. authorities are now on a vastness of alert that the actual socially distanced crowd at the Capitol tomorrow will presumably be severely outnumbered by their guards. However, the relative security presence today in Washington after the recent debacle reminds me of the old Not the 9 o'clock news breakfast sketch where presenter Mel Smith intoned seriously with words to the effect of, "A recent psychological report has shown and helped explain much of the US arms buildup during the Cold War. Having been late for the last two world wars, the Americans are determined to be bang on time for the next one." Since our last show, the first new word of 2021 has emerged in financial markets, Gensler-Freude. That's the term Exchange Invest has coined for the feeling of shameful joy which emerges when many bankers back the Biden-Harris electoral ticket only to be rewarded with their worst possible choice of regulator. Welcome to the Securities and Exchange Commission Chairman Gary Gensler. And for good measure, the equally anti-capitalist consumer czar is going to be one Rohit Chopra, very, very much like Gary Gensler on the hard left of the Democratic Party. Back in the UK, there are concerns. High-tech British firms are eyeing US listings in a blow to post-Brexit London stock market. Ignore the Brexit nonsense, that's just flannel at the moment. Xavier Rowley actually surmised it very succinctly recently. Europe simply does not have the equity capital markets that understand and price innovation appropriately. That's the issue, nothing to do with Brexit. Tech firms preferring to list in America, well, that's a hardy perennial because in the United States of America, well, at least pre-Gary Gensler, markets worked. And as even the former London Stock Exchange boss Xavier Rowley has noted, European markets don't. When it comes to achieving quasi-insatiable levels of investor appetite at healthy to high valuations that are simply not achievable elsewhere, the United States continues to remain supreme. Against that background, on Monday, Marcus Ferber, MEP, has suggested that there ought to be a master plan to grab euro-denominated finance from London and the rest of the world and make the Eurozone a centre point of global trade. Of course, integrated markets, a Eurozone powerhouse. Hold on, what could we call that master plan? I know, why don't we call it Capital Markets Union? Oh, hold on a second. Well, let's be charitable. Perhaps an appropriate statement to reflect on Monday, which was, after all, Martin Luther King Day. Marcus Ferber has a dream. Elsewhere in the Eurozone, Christine Lagarde, a serial panjandrum of multinational financial entities, right now it's the European Central Bank, reckons there will be a digital euro within 5 years, which at least shows supreme optimism. She clearly thinks there will be an underlying euro, some might even say an underlying European Union, in 5 years' time. Well, indeed, maybe the euro has a digital future. Settle today announced that they've traded a central bank digital currency over their Settle architecture issued by the Banque de France. All this and more is being discussed daily in much greater detail and much greater pith in Exchange Invest Daily, the unique newsletter of the Bourse business. Send us an email or hit me, Patrick L. Young, on social media via whichever stream you're watching this, and we can get you signed up to understand the exchange business better. Meanwhile, as I said last week, Exchange Invest is an entirely non-violent platform, but we do like one thing to be hit. Smash that like button, ladies and gentlemen. Like this wherever you are, whatever social media you're watching us on. It helps get us up the social media rankings and means that you manage to see fewer and fewer TikTok stars at the top of the rankings. Oh, if only we could ever manage to get there. Anyway, give us that New Year's boost and help the search engines get away from all that negativity in the COVID sphere. Talking of non-negative news, exciting news nonetheless, 74% of proprietary traders in a poll are looking towards emerging markets for the future of their exchange derivatives trading. That's according to a survey by Acuiti. And As luck would have it, our guest today is Will Mitting. He's the man who founded Acuiti in February 2019 to bring greater transparency to operations across global capital markets. Will was previously the managing director of FOW and Global Investor Group at Euromoney International Investor, PLC. His previous experience includes launching the first magazine publishing business in the northern region of Malawi. Well, greetings, Will. How are you today and where in the world are you?
Thank you, Patrick. Good to be here. So I'm dialing in from London in a very quiet and empty city at the moment.
Wow, so you're actually in the office in the City of London?
Yeah, I think the rules stipulate that if it's unreasonable to work at home, and I have 3 small children in a small flat in Holloway, so I think that on occasion, I don't know if anyone wants to challenge the reasonableness of working from home with my children, they're welcome to try it. I think they'd soon agree with me.
Well, I see we've had a magnificent couple of comments already from Danny Corrigan. Good to see you this evening, Danny. Did you know financial markets employees are considered key workers in the UK and receive preferential treatment in queue for the COVID-19 vaccine? So there you go. Well, you might be in line to get yourself COVID vaccine slightly earlier. You can queue up along with the grannies and other people. And indeed, on that note, thank you for your comments, Danny. And indeed, we were talking about Settle. It was a central bank digital currency transaction. It was announced today. It's on the Settle website, which I do believe is settle.io, if my memory serves me correctly. The Bank of France have issued a couple of million of a central bank digital currency. It's a test. It's gone through the, and I'm going to get the name of this wrong now, IXNUS, something like that. That's going to be, well, it's a test. It's in the Eurozone. They've got some sort of a central bank digital currency running. So, apparently it's the USA that you can actually manage to get that priority. So if you're sitting there having lunch, try and stay with us until at least the end, at the top of this hour, before you rush off in the USA in order to get that vaccine. If you're in San Francisco, you've still got plenty of time before the morning's over, in fact. Now, Will, tell me a little bit about yourself, because you've got this, fantastic footnote to your career. We just love it. You created the first magazine publishing business or something in northern Malawi. Now, how do you get there in the first place? That sounds like quite a story.
So as with many things in life, especially the good things, it was following my wife in my wife's footsteps. So in the run up to our marriage in 2008, she's a doctor, and she always talked about how she wanted to go and work overseas, and never thinking it would happen, always agreed we would. And then the time came when we finally did get married in 2009, that I'd run out of excuses. So we decided to up sticks and move to a place called Mzuzu in northern Malawi, where Becky was she ran or worked on and ultimately ended up running the children's ward at the local hospital. And I decided, having looked quite extensively into really the options, I think at that stage you were encouraged very much to go into a charity project, but having read quite a lot about aid and the failings, and reading books like White Man's Burden, etc., and trying to understand the failures of aid over the years, I thought that a better model would be to try and understand how business can propose a solution. So decided that instead of going and volunteering for charity, I'd set up a business, which we duly did, not expecting by any means to be the first publishing business in the northern region, but it did turn out that's what we were. They had a local radio, but it was an incredibly poor region with very little infrastructure. So it did turn out ultimately to be the first magazine publishing business in the northern region of the country. Wow, and how did it go? Yeah, it was fascinating. It was an incredible experience. I think you don't prepare yourself really for the challenges, both in business-wise and emotionally. So certainly on the business side, it was at times just mind-numbing. You cannot rely on electricity. You travel, you drive down to the financial capital in the south, and then the country would run out of petrol, and you'd be stuck there for 2 weeks. The constant corruption that you had to deal with, which was just made it incredibly challenging to get things done. But on the other hand, the opportunity and I guess the environment there and the willingness of people to accept and adopt new ideas. It's a whole country of entrepreneurs, and despite the challenges they face in daily life, it was an incredible experience, and probably the most profitable publishing business I've ever worked for, on the basis that we were the only ones doing what we did. So we used to have a seminar on how to advertise, where we'd invite all the managing directors from the local retail businesses, and we'd enthuse them on the benefits of advertising, and we would be the only vehicle through which they could do it. So the profitability of that business was immense. And today, when I left, I sold half the business off because we set up 2 magazines. One was a business magazine which was focused on nationwide finance, and that obviously I think that was difficult to run from Mizuzu, so I sold that to a company in Blantyre, and then handed over what was remaining of the business to the local employees, and they still, they fully own it, and they still run the business today. And I would guess it moves at a slightly slower pace that I tried to drive it back in when I was there, but it's still going, and it employs, I think, about 30 or 40 people at last check-in. So it's one of the largest employers in the town that we that I launched it in. So I think overall as a model, I think it's quite an interesting one for replication in the future, potentially.
That's absolutely fantastic. How to get ahead in advertising. Eat that, Richard E. Grant, when you're the only business in town teaching people how to do advertising in the first place. It's quite magnificent. So you had a publishing background before you went to Malawi?
Yes, so I've always been in business-to-business publishing, so kind of trade media, or what was historically the trade magazines. So I went to uni in Birmingham, and then was part of a startup when I left. No, not a major part of it, but I was a launch editor of a magazine focused on corporate finance in 2004, 2005, and then from there went to Haymarket, moving down to London, and ultimately to Malawi, then Euromoney.
Oh, excellent. Altogether, and a career at Haymarket, a business for whom I freelanced over the years, but always in their automotive titles in a previous life, actually, when they were king of the kids in automotive titles, well, a few decades back. So interesting. You got to London, you got back to London after your interesting sojourn, and you became the publisher at Euromoney Institutional Investors, future not FOW, or indeed it was rebranded while you were there, wasn't it? FOW arm. And then from there, you decided to jump into doing your own thing, be entrepreneurial again.
Yeah, I think it was always a goal. It was always something I wanted to do. Certainly made no secret of when I was at Euromoney. But yeah, I think the time. Well, I was going to say the timing was right, but obviously didn't anticipate a global pandemic in that timing. But I felt that I'd done what I could at FOW. I think we turned around to a large extent some of the businesses. We'd grown what was ultimately a very successful events business, and then overseen the merger with Global Investor Group. And so I felt after doing that it was the right time to leave, and then moved on to launch Acuiti, really looking for another challenge and to realise a life goal that I guess everything I'd done to date was working up towards.
Fabulous. And so tell us a little bit about Acuiti.
So I guess Acuiti came about from an analysis of the B2B publishing market. I think if you look at the evolution of that industry over the past 10, 15 years, a lot of people think that the internet has completely overhauled the business of publishing, and to a large extent that obviously is true in the revenue streams that used to be driven by print magazines, which was a wonderful life. You could do as an editor, you could do a couple of weeks' work and make easily enough money from advertising to produce a monthly magazine. And the shift online, obviously, as you know, Patrick, the business model for online publishing and online advertising is far less generous to the publisher than obviously print was historically. So that's been a challenge for publishing. But I think fundamentally what is not fully appreciated, and certainly has not been fully responded to yet within the publishing industry, is that the internet has resulted in a loss of monopoly of audience. So historically, if you worked in B2B publishing, whether that was for FOW or for doorknobs or wardrobes monthly or whatever it might be, you pretty much had an exclusive ownership of that audience. And if somebody was trying to sell into that audience, really the only channel they could do was through you or through one of your competitors, of which in most industries there were several. Whereas the internet obviously has democratized that access. So nowadays everyone has their own audience. You go on LinkedIn, you go on your social media, you go on Twitter. You have access to what was historically an exclusive audience for B2B publishing. So what Acuiti, I guess, is trying to do is really understand or what value B2B publishers can offer the market in a world where they don't own the audience. So what we're doing here is every process, every bit of content, every concept such as events, we're looking at and saying, well, how do we do it better? How do we change the model? Because I think the actual core publishing model, again, hasn't changed for 100 years. If you look at your publishing news, your publishing analysis. So what we're trying to do at Acuiti is we're trying to provide a platform through which people can share information and share ideas, share actions, share processes. So everything we're doing is around that single concept of let's build a platform that senior executives from initially the derivatives market can come onto, and they can share information with the interest of providing transparency over operations. So that's what we're trying to do, and we've made some steps. Obviously, COVID knocked us back a couple, but in 2021 we've got big plans for developing that.
Well, it's quite incredible. I tip my hat off to you because you really had a bit of a nightmare last year because you were just getting things together beautifully. And then COVID, bang, everybody was thrown out of the office and suddenly nobody was meeting anywhere.
Yeah, it was a major challenge, obviously. I think that certainly the immediate challenge for us was revenue-wise. We'd forecast going into 2020, our business model was let's make money from events, let's cover costs from events, and then we can innovate in terms of research and data sharing underneath the protection of the events business, which is probably, apart from cruises for 90-year-olds, one of the worst strategies you could have got into 2020 with. So we very quickly had to refocus. So there was some very long nights in March where it looked, if I'm honest, there were times when I thought, well, at least if it does fail, it's not my fault. But ultimately, we focused very hard on the research business that we were already building. So it was an interesting challenge to be told 12 months into a startup that you cannot make money from the only proven revenue stream you have. But I think because we were small, because we didn't have a big track record or big revenue streams to defend, it enabled us to be much more nimble. And as you referred to, I think the second challenge, which I think was actually a greater one, was the operational side of it. And my wife is an intensive care pediatrics consultant, and her ward was turned into a COVID ward. So she was working every hour God sent, and the kids would generally, I got at the time I had 7-year-old twins and an 8-year-old, slightly old, well, a year older now, but 7-year-old twins and an 8-year-old to look after during a pandemic where we had to homeschool for a lot of the time. So operationally was the most challenging, just trying to find the hours of the day to turn around the business and obviously predominantly support Becky and what she was trying to do, because clearly that was far more important than anything I had on my plate.
Well, clearly, I think it becomes a lot more transparent the more you speak just why you're in the office on your own at the moment trying to do this live stream rather than sitting at home with 3 children under the age of 8. I'm sure that's going to be quite an exciting effort. And when you're at home, it must be, well, probably life-affirming, like the old life pits were somewhat life-affirming. Thank you very much, Tom Lant. Hello to you. Good evening. It's good to see all of you this evening. Thank you so much for all your messages. Danny Corrigan, yes, I would agree with you. Settle are absolutely awesome, and some of the things they've been doing recently, quite impressive altogether. Any of you, please send us a question. What would you like to ask? We are going to be talking about actually some of the research and some of the issues that Acuiti have been raising recently when they've been going out and polling the market. So send a message, what you'd like to ask and to discuss with Will. And don't forget, of course, before you finish this off today, please hit that like button or send us a comment, send us a question so that we can interact with you and make this the best possible show that you can manage to get. Great stuff. Will, so you have a multiplicity of reports have come out. What particular major landmarks have you seen in terms of your development so far in some of the research that you've unveiled?
Well, I think we put out about 15 commission reports last year, as well as our monthly insight report. So I think to separate those out. So the insight report we produce monthly is based on a snap poll of senior executives from across the global market who share with us, anonymously share with us information on things like revenues, operational challenges. I think obviously this year has been fascinating in terms of the diversity of revenues. I think we saw obviously March, April, a huge spike in revenues across the board. Some firms got hit on the wrong side of the volatility, but we saw some firms were reporting that they had made their entire annual revenue of the previous year in 1 month. So that huge spike in revenues was followed by a slump. I mean, just the most barren landscape for trading. I think in August, Eurex's volumes were lower than they've been or second lowest month for about 15 years. So we saw that just this year of feast and famine across the board was picked up in our monthly survey, and I guess that report is almost like a heartbeat of the industry. You know, it's there, it's always there, and it's interesting when it stops or goes faster. But it's nice just to know it's beating away. And then I guess related to that, obviously a lot of the work we've done since March has been around understanding how COVID and the volatility has changed attitudes to things like investment and post-trade, to trading new markets, as you referred to at the beginning. And over that, what we're seeing again and again is a reevaluation, I think, of capacity and a major focus on operational resilience. Obviously, when everyone moved to the remote environment working from home, I think you won't find many people who were surprised at how efficiently that went, and it's a testament to the resilience of the industry that they were able to shift globally and seamlessly to remote working environments from a trading, back office processing, compliance perspective. But the technology, I think, came under pressure. We certainly picked that up in a snap poll we did in April. We found that 58% of clearing firms that responded to the survey experienced major issues with back office processing and reconciliation. And we followed that up with a report with Broadridge that came out in November, looking at how that's changed attitudes, and we found a massive increase in investment coming down the line in post trade. So I think overall, the story of 2020 was one of understanding where the limits of current operations are, and 2021 I expect to be about solving those in a way that is more comprehensive than they've been solved historically, if that makes sense.
Fascinating. So looking at that whole situation, I mean, you mentioned this whole thing. I mean, volumes exploded in the early part of last year. The miracle, I mean, the incredible thing, and we have to take our hats off and salute the entire industry, is how well that worked, because, you know, we had really next to no downtime. We had the exchanges worked. Pretty much every broker worked. Yes, there were all sorts of pain points in the clearing end of the market, etc. Where do you see the pain points, or where are you hearing the pain points are at the moment in the exchange traded derivatives world?
Yeah, I think that's the key point, that it did go incredibly well, and it is testament. So I don't want any discussion you have about where areas can be improved shouldn't crowd out the fact that overall it worked remarkably well. But it's certainly post-trade. I think if you look historically at the amount of money that's been invested in the front office versus the back office, you know, you're capable now of trading in almost picoseconds, I think is the latest frontier. I'm sure you'll correct me on that, Patrick, but it's immensely fast trading, whereas some of those trades are then cleared into a system that's powered on a green screen. So there's a mismatch, I think, in the market, and that is one of technology investment, but it's also one of harmonization across the market. We did a project with Euromoney Trade Data looking at reconciliations and as a reference data, and I think one of the key focuses as well, or one of the key areas that were exposed, or has been exposed and is known about for some time, is the challenges that the fragmentation of reference data across the market poses. So where you have a bank sort of whose operations have come together through mergers or through internal silos being broken down, they often speak different languages in the back office, and obviously clearing systems will speak a different language in terms of the symbology to the front office. So an enormous amount of money has been invested by the tier one banks in resolving that, but a lot of that has been spent in offshoring people in order to throw human capital at the problem. And I think the next phase of that evolution is to start fixing it from a technological perspective, which clearly in the long run will be much more efficient. And I guess again that's something that probably the volumes and the volatility in March exposed, is the limitations of technical issues that have been solved with patches over the year, or just adding more people over the years. So I expect that to become a major trend in 2021.
Very interesting. So there's obviously going to be a lot of investment. Some vendors will be salivating, but at the same time, it sounds as if some vendors have to be worried because they're still selling solutions with green screens in certain places. And obviously that's quite a big change that's going to take place. What about the overall other side of the spectrum? Because obviously, therefore, if people are investing, that means their costs are rising. Is there any flexibility? Does that mean we're going to see fees going up for transactions in ETD?
Yeah, we've already beginning to pick up fee increases. So it was first became apparent in July. So our report, every 6 months we ask about a cost basis and fees, and we saw in July the beginnings of FCM starting to raise fees, in particular in the option space back in July. Now in the report that came out today, we see it much more broad-based fee increases in Europe and the US in particular. There's still very tight competition for pricing in Asia, but we certainly see fee increases for futures coming in from the FCMs down to clients in UK and the US, and I think ultimately I'm sure I'm going to get a shot for this in some corners of the market, but I think generally that would be accepted. I think that's fair. One thing that the crisis certainly exposed was the risk profiles that each participant in the market is exposed to, and I think the FCMs versus the risk versus reward, I think the FCMs are the most disadvantaged in that respect. You have the exchanges, obviously the host of it, who are exposed to very little commercial risk. Obviously the props, the hedge funds, the end users have a great risk, but also they are party to outsized rewards when trades go well. In the middle, you have the FCMs who's I'm not saying they didn't make good money in March and April. Now, as we've discussed, the volume increases meant they did, but there we saw a couple of high-profile blow-ups and big losses from the FCMs, and I think that really brought to everyone's attention how significant the risks for FCMs are, and also the potential threat to sustainability and the long-term commitment of some FCMs in the market. And there seems to be a very general, broad realization that it's worth spending a little bit more on the FCMs to make sure that they're there and providing good competition in the market.
Well, certainly also it's been a bad decade, if not longer, it's been a bad generation almost now for the FCMs, because in the past they were so used to making money out of haircuts between what they had to sequester and what was going into the clearing houses, whereas nowadays where interest rates are actually negative, it can be a problem to have that much money on your balance sheet, which has been a huge issue of tension for the FCM community.
Absolutely, and some of them have done a lot to address that by taking some of the interest payments off the balance sheet in that respect. But I think it's really shown in the report we put out today. At the end of last year, we asked whether people expected, this was in early December, so really almost at the end of the year, we said, do you expect 2020 to be an exceptional year or a good year or a poor year for revenues? And we broadly found banks and prop firms both saying, certainly 60-70% of them in the category saying it was either a good or an exceptional year for revenues in their business. Going into 2021, we're asking about headcount increases and the expectation for raising headcount. So if you assume that these businesses are going to 2021 with roughly the same performance in 2020, and we see a massive divergence in terms of how the sell side is looking at, also how the banks in particular are looking at 2021 compared to the props and hedge funds. So, for example, props and hedge funds, 82% said they expect to increase headcount during the year, compared to just, I think it was about 30% of banks. In fact, 35% of banks, I think it was, are actually expecting to decrease headcount over the year, with the business development roles expected to be the most likely ones to be cut. So there's clearly very, very different outlooks for the year. And I think that just brings home again the challenges and the pressures that banks are under in this zero or near zero interest rate environment.
And what about the clearing industry per se? What's the sort of feedback about there? Because I think one of the things that I particularly worry about, and I know I'm not alone, and I certainly mention it quite often in Exchange Invest, is the idea that we're going to suddenly lose some more of the GCMs. Because, I mean, the GCMs per se are, well, first of all, in some ways, they're a bit of an anachronistically titled, because in this day of thousands of markets, nobody's really a GCM the world over. But certainly, there are, say, 20, 25 major players across the world, but most of those are regional. There are really very few who can service a broad swathe of the world. How are their finances? What are you getting as the feedback from them as a group in terms of how they're viewing the future?
Yeah, I mean, first of all, I think that the argument about, or the analysis of GCM consolidation is overblown. It's often, if people tend to look at the CFTC report they put out every month and the number of registered FCMs with the CFTC and say it's gone down from 190 to 80 or 90, whatever it is today. I don't know the exact figures, but it's gone down significantly over the past 15 years. We did a report last year which analysed exactly how much consolidation there had really been, and we found that there had been some consolidation, but that generally was pre-2008. And in fact, most of the firms that had come out from the CFTC register either had low to zero customer assets, or they were multiple entities of the same ultimate parent. So I think the first point probably is that the GCM consolidation has been overblown. That said, there are certain markets where there's been significant retrenchment from. So while the overall number of firms, there have been some pullouts, but the overall number of firms is broadly the same today as it was a decade ago. It's very specific to client base. So if you're a large asset manager, you have almost, or a corporate, you have almost unlimited firms you can go to clear your positions. If you're a broker or say an options trading, options market maker, you have very, very limited number of firms. So I think that there is an opportunity there, and I think we're increasingly seeing signs that opportunity is being looked at more aggressively from some of the banks who, obviously moving on to the different margin or the capital treatment regimes in the US allows them to service options clients in a more capital efficient way. I think we're going to see people coming into that market offering clearing services to options firms, in light of the fact that there has been that pull away over the last decade. We also see banks that are coming back into the market. You know, UBS, obviously there was an article in Risk the other day, Connor Cunningham's there, and he's building back UBS's clearing capabilities back. And I heard there are a couple of other banks that aren't yet public, but I've spoken to about them looking to do that as well. Firms that traditionally were relatively large in the market that pulled away and are now coming back in. So I think you're going to see more firms coming in. Obviously, capital rules are a major issue for that. But assuming they're sorted out once interest rates come back, if and when they do, and it's a more favourable environment, I think it'll be very quickly, you will see competition return across the market.
So just going into that for a moment, what are the motivating factors you think, or that you're hearing, that is likely to bring new GCMs into the market?
So I think it's the growth of entities in the hedge fund and proprietary trading space. We don't have any empirical evidence on the prop side, but while growth in hedge funds has slowed, as I understand it, I think there are more coming in. But I hear anecdotally there are more and more prop firms launching, certainly as a result of some of the successes in 2020. And also it's the regional expansion. I think you're seeing more aggressive client base from Asia who want to get into international markets. So I think the pie is growing, and that's the first time. That's, again, a bold statement, and I'm sure I'll get tripped up on, and there's nothing empirical behind it. It is anecdotal, but my sense is that the pie is growing. And I think the other point is that clearing ultimately was a good business when interest rates were high. So should interest rates return, it will be a good business again. And for a lot of people, it is a good business still with rates where they are. Finally, I think that a lot of banks who pulled away from clearing realise that they are lacking something. They're not able to offer clients a full service. So certainly the banks I've spoken to recently who are pushing back into the market have very strong franchises in specific parts of the market that they're looking to offer a more universal service to clients. So I think those are probably the major trends that are driving people to look back into this market.
Very, very interesting in the whole GCM business, as you say, and probably the greater accessibility of more modern software that doesn't actually happen to be harking back to the green screen era with a plug to COBOL somewhere in the back is probably enthusing people as well. And actually, I mean, when you talk about the pie growing, I mean, you look at some of the equity statistics we've seen in recent times, and certainly the 10 million people who suddenly appeared out of nowhere on Robinhood during the course of last year. And actually, I mean, the Moscow exchange last week, they had incredible statistics for equity trading, admittedly not exchange-traded derivatives, but they welcomed 5 million new customer accounts during the course of last year, which was actually not just more than they've ever done in any one year. It's actually more people than traded in their history. They started at about 3.5 million, ended at 8.5 million. So I think there is intrinsic evidence that the pie is growing all the time, and certainly the options volume seems to suggest that, which is quite incredible. Speaking of which, hello to several guests this evening. JC, the messiah of the front end, as he once was. Jonathan Cowan, good to see you. Thank you very much for your comment, Jonathan. It's great to hear from you. Glad to know that you're well. We've also got an interesting, well, we've got a couple of questions. I'm going to go to Stuart's question first. Hyphenated Stuart is asking, do you think that clearing fees should be a function of time position is held rather than simply on a per trade basis? Well, that's quite a deep question.
Yeah, I mean, that's slightly, I guess, slightly beyond my area of expertise. But I mean, how would you work that out? Surely that would be an incredibly complicated schedule. I think one of the things that we're picking up on across the market is the need for greater clarity of, or less complexity of fee structures, more predictability of fees. So I think if you're going to introduce a consideration such as that, how would you do that in a way that didn't just introduce far more complexity and less transparency into the ability to forecast costs?
Stuart, thank you very much for your question. If you want to ask another and come back with another one, I'm actually thinking of something. When you've been doing your research, and maybe you don't actually ask this, but I note that you've been talking about people saying they're raising their fees and so on. Do we have any sort of a feeling of by how much fees have been raised recently? And I don't seek a precise number, but is it 2%, 10%, 20%? Do we have any sort of an idea of the increment?
Not yet for the clearing side. So we are looking at doing something along those lines coming up over the next few months, but we've got to be careful of competition, anti-competitive behaviour, obviously, as a result of that. No, so we don't see how much is being raised by, aside from on the market data side. We've just done a big study into market data, which is coming out in February, and that we do ask how much fees have gone up by, and it's pretty shocking. I mean, firms are recording tripling or doubling or tripling of total fees on market data, when you think that the banks generally are paying $250,000 a month or more in market data fees. That's a considerable amount of increase. So on the clearing side, not yet. It's something we're looking at how we get that.
Very interesting altogether, but certainly, I mean, some of the fees that you're talking about that are doubling or tripling had become absolutely wafer thin. I mean, barely pennies on the dollar, presumably.
Well, so that was specific to market data fees, the fees charged by exchanges. But you're right, for the FCMs, the per trade fees are very low, especially when you compare it to what the exchanges are generally charging.
You're quite right. Well, sorry, I was just basking in the glory of Jonathan Cowan's very kind comment, because he says that he's reading my book, which I will therefore emblazon: Victory or Death. If you want to learn the future of blockchain, cryptocurrency, and the fintech world, it's got a foreword by none other than Jeffrey Sprecher, the chief executive of the Intercontinental Exchange, an organization who are well known to everybody in the exchange-traded derivatives business, to put it mildly. If you're not in the exchange-traded derivatives business and you're listening, he's the chairman of the New York Stock Exchange. So, interesting to hear from you, Jonathan. Thank you very much. I hope you enjoy the book. I look forward to your feedback. I hope all's well with you and in your technical analysis ventures et al. So, Will, we've got another great question here. Shifting gears ever so slightly, it's looking at remote working. So how are exchange-traded derivatives companies looking at remote working going forward? Have you grasped any interesting insights yet?
Yeah, we asked at the end of last year, when firms were expecting a return to the office. And it was, I think it was a second or third time we'd asked that. And each time the dates when people expected a full return to the office has subsequently passed, obviously without it. So what we found, and I can't remember the exact statistics, but the overarching conclusion was that there is not expected in any way to be a significant shift of to home working in the long term. In terms of timings, at the top of my head, I think people expected by the end of during Q2 to be fully back in the office, and only a fraction, I think it was 2 or 3% of people thought there would be a permanent shift to working from home for a majority of the staff. So while you hear this commentary elsewhere in the market or elsewhere in the world about this new shift of home working, we don't pick up anything to suggest that will happen in the EGD world.
Very interesting altogether, and therefore good news to hear that we were the first people to lead in the whole business of managing to be ahead of the curve in terms of how to make home working work, which we did incredibly efficiently throughout the parish of exchanges and indeed exchange traded derivatives. But at the same time, we're going to be leading the vanguard back to work, which is good news for all those of you who are currently watching this live stream while the cat is probably attacking your slippers and the children are screaming in the background. Soon, your colleagues will be screaming in the background and everything will be back to normal. Thank you very much for the kind comments and all the questions. We've still got time for more. We've got 20 minutes left, ladies and gentlemen. Don't forget to tune in, check in exchangeinvest.com, and please sign up for a subscription to the daily newsletter of the horse business. If that tickles your fancy, drop by Acuiti.io and look for some of the reports. You've got various reports, if I remember correctly. You can even sign up for, and some of your stuff you distribute for free, Will, if I remember correctly.
Absolutely right, Patrick. Yeah, indeed. Sign up and yeah.
No, excellent. I mean, it's a really, really great service altogether. So what do you think? I mean, looking at the noises you're hearing back from the market, whether it's in clearing, whether it's on the technology side, whether it's on the data side and so on, or the brokers themselves, what are the things that people are most concerned about right now in the ETD industry?
I think... Well, I mean, in terms of what's unique, I think the thing there's a problem in Europe. I think European revenues are subdued compared to Asia and the US. We obviously don't have the big retail options market that you have in America. We don't have the growing base of new users coming into the market that you have in Asia, and obviously other emerging markets like South America, etc. Brazil in particular shining. So I think the broad answer, I think, is in Europe there's a concern over what's next, where does the growth come from next in the industry, and people are looking enviously across the world at other opportunities and people steaming ahead. But aside from that, I think it is all about sustainability and resilience, and as I said before, I think that is top of the list of every executive in the market now, about how to build a longer term, more sustainable, more automated infrastructure for trading, and the exchanges are not alone exchanges are not exempted from that conversation as well, despite the fact that they too perform well. There have been high profile blow ups. So I think it's just about operational resilience going into throughout 2021.
Yeah, right. So operational resilience is obviously therefore a really key thing. People are very worried about it, and rightly so. But on the other hand, so far so good. The actual progress has been incredible in the exchange traded derivatives world. And you look actually at some of the major outages, and they've all been with brokers on the cash exchange, equity exchange market, rather than being particularly anybody in the derivatives brokerage space most of the time. How do you see, for example, within the European space, is there any way that you think that there can be improvements to liquidity, making those markets go better in the American mold?
I think it's all about stimulating the retail participation. Obviously, there's many. The European market is very different to the UK, to the US markets. In particular, the CFD market doesn't exist at all in the US. So the competition from that market is immense. But I think that is the way. That's where the growth and increased participation needs to come from. And you've got to expect, especially if you look at the FX markets, as firms or as traders grow, and millennials grow up trading, they're going to be less than satisfied long term with the cost of the CFD market. So futures will be a natural shift for them. But I think it would be remiss of me not to talk about ESG as well. ESG clearly is an area of immense opportunity, and it's something that exchanges such as Eurex are taking the lead in globally. So there is definitely innovation there, but I think you need to broaden the participation in European markets to the same levels in the US markets. Otherwise, we're going to be increasingly left behind.
Yeah, I mean, it's quite marked. I mean, we were discussing this a number of live streams back with, including others, Kevin Kennedy of NASDAQ. And it's very interesting because you take even a company that's listed in Europe and listed in the USA. And I think one good example would be Ferrari, which runs under the acronym RACE in the US, certainly. And I mean, Ferrari options during the day in Italy are just appalling. I mean, you couldn't just drive a Ferrari through them. You could, you could drift a Ferrari through them absolutely sideways while towing a caravan. And then suddenly at 3:30 in the Central European afternoon, 2:30 London time, it's incredible. The whole world changes. And in the US, you have that amazing options infrastructure, and the prices are totally competitive in terms of the bid offer spreads and what you can actually trade. So there's a load of work to be done there, obviously. Now, the one you talked about, you mentioned it earlier, you've got this big thing coming on market data, and obviously market data is a huge hot potato at the moment. So almost anything you say is going to be deemed controversial. No pressure there. But at the same time, you're just reporting what you've heard from the set of data that you're talking to. So can you give us a little bit of a feeling of what the marketplace is telling you about the issue of market data in 2020 coming into 2021?
Yeah, and as you say, it's probably one of the biggest hot potatoes in the industry right now, and it's become a lightning rod for a number of issues and come to represent a number of issues. So I think there's so many different dimensions to it. What we're trying to do with the report is in addition to a customer review of market data feed providers, which is part of our customer review series, and we're getting in deep insight reviews of those providers. In the first section for each of these projects, we analyze the market and analyze the conditions. There's so many issues, and what we don't want to do is just have everyone thinks market data is too expensive and the exchanges to stop charging them. I think generally there's a realization that the exchanges became demutualized around the turn of the century, that they are now independent listed businesses who have to make money through growth. So the question we're trying to ask is market data fee charges, the way they're currently structured, optimizing growth, or is it holding back growth? That's one of the questions we want to explore. Another one is, assuming that you're not going to be able to just eradicate market data fees, how best should they be structured? And I know there's a number of regulators also looking into this topic. But interesting, what we find is that everyone argues for an exemption for themselves. So you'll have market makers saying we should be exempted because we are providing a service and we're trading all this volume. You have other people say, well, the market makers, we should be exempted and the market makers should pay because they're getting paid already. So, they're already making the money. They're making money from our trade, so they need to pay. So I think if you look down, we're trying to understand solutions, and exemptions probably is not the right way to do it. So then you come to what are the possible solutions. And I think simplification and harmonization is probably where we're going to end up. Now, still, we haven't finished the data analysis yet, and we still got a little bit more data to collect. But I think it's reducing the complexity. It's getting rid of things like the same user paying 4 or 5 times across multiple devices and display, non-display, these what are these days nonsensical or certainly less relevant splits in terms of usage than they were previously. So I think it's harmonizing complexity, and will have to be some give from the exchanges as well, I think, if they're going to solve this problem. And long term, I genuinely believe it's in the exchanges' interest to do it. As I mentioned, regulators are looking very closely at this. If they don't, I think, make moves and start to give a little bit, they're going to get hit with quite a draconian sanction that might be more damaging to their market, to their business as a result of being able to charge market data fees significantly lower than they do today. I think there's what's called for is a bit of each side meeting it halfway, but an end to the constant rises, an end to these audits that are designed purely to find something that they can charge for, and that I think peace will break out again in the market, and I think everyone will be a lot happier as a result.
It's very interesting because, as a kind of boil on the bum of progress when it comes to futures trading, because I'm only really buying one data feed at a time, or maybe two, I actually don't see any major change in data prices over the course of the last 20 years. One or two exchanges have gone catastrophically, seismically more expensive, and I don't trade there. But most of the rest are actually about the same price for one user. But I hear what you're saying. It's such an interesting issue, this audit culture where you get a man with a clipboard who used to work for one of those odious consultancies is running around trying to find something you've done wrong, and he feels like one of those people from the Performing Rights Society who are always trying to catch you out if you run a cafe to see whether you've actually allowed for all of the square footage in your shop, etc. It's just annoying box ticking and doesn't really seem to make any sense because it upsets the customers. At the same time, to be fair, exchanges are processing a quantum of data more than they were pricing 2 years ago. So, in that sense, prices haven't necessarily gone up a lot, but there is a huge burden of cost, and obviously we have to think about it. So I want to actually jump to a different topic. We might come back to market data in a moment because we've got a super question back from Stuart. He's asking all about ESG. So what is your opinion, Will, on the future growth prospects for ESG? And is a serious uptake of ESG products in the ETD space? Is it a fad? What do you reckon?
So no, it's not a fad. It's this is driven by real money and serious amounts of real money. So obviously it was born out of the Nordic asset managers, big Nordic pension funds, and the question, I guess, is not. The ETD space will reflect what's happening in the broader market. My guess is that will only grow. I think there's a number of issues that are currently holding back growth. Obviously, the language and how ESG is quantified and it needs to be harmonized to a large extent. So we need to establish common standards for how it's measured. But undoubtedly, there's a groundswell of ESG in the real economy, and that will only grow, I think, as millennials and the generation below them mature. So ESG is very nascent, in particular in the ETD space. It's very nascent, but you've seen significant growth. I think one of the fastest growing contracts in Europe last year by notional was an ESG contract on Eurex. So no, this is here to stay. The product will evolve, so I think it will look very different in a decade to how it does today, and people will think about it very differently to how they do today. But I think rather than being a fad, I think it will just become how people invest.
Very interesting altogether, and obviously the incredible rise of indexation surrounds us in the ET business, as we saw last week when we were talking to Mark Makepeace, and that's one of the back issues you can catch up with on wherever you're streaming today. You can go and Google and search for it, also on YouTube at IPO-VID. You can catch any of these conversations. If you've got a question, let me know. We will be happy to answer them. We're into the last 7 minutes of the show today. Thank you very much, Stuart, for your questions. Those have been most thought-provoking altogether. So looking forward then, what else do you think in terms of, the search for what are everybody's out there looking for more money. Is there something you think you can identify that is something that is going to provide or help increase the revenues of the ETD business players?
I think it's the ongoing globalization. I think that's where the opportunity is for everybody, but in particular for trading firms. And the report we had out today that you mentioned at the beginning of 3/4 of firms looking for emerging or frontier market, or to trade emerging or frontier markets over the next 12 months. That's a huge opportunity. There's so many markets out there with very, very nascent, some non-existent derivatives markets. And you see Saudi Arabia obviously launched their first, or I don't know, you're pretty correct, man. Did they have something historically? I don't know. I'm not sure they did, but they launched the recent iteration of their futures market last year, and they're planning to grow that over the next 2 years. And then obviously China. I've been following China now for over best part of a decade, from my early days at FOW, and just seen just immense growth in that market, not just in terms of volumes, but in terms of the number of products launching. And if you think there's still probably, again, I'll be correct on this, but I think probably less than 50 futures contracts that trade in China. So there's clearly huge potential for growth in that. The listed bond market is very, very nascent currently still, in its current iteration. So there's definite reasons to be optimistic, but it is about tapping into that global growth and making sure you're not left behind. So innovation, I think, in Europe is more important than ever before. We need to make sure that we're an attractive market for international investors to come into, rather than just providing what we need for local investors. But I think ultimately, if you look globally, there's so many bright prospects. It's a really good time to be in this market.
Well, it's lovely to have such optimism. Isn't that great to hear? I mean, good grief, we've barely managed to mention COVID for 15 minutes. You're optimistic for the future. And actually, the one thing that is really encouraging here is that it sounds to me as if, despite the challenges that are going on, and there are some knotty issues to solve, no doubt the exchange-traded derivatives business seems to be net optimistic, as it has long been. Is that a fair comment?
It certainly is. So we picked up again today in the report we put out today, 62% of respondents are optimistic about growth over the next 3 months. I think before we found a majority that thought this year was going to be quite volatile. So I guess if you look at the short-term drivers of volatility, you could argue that they're bearish. Interest rates being low for the foreseeable future is clearly a major challenge, not just for banks, but also for trading firms who are trading volatility in those markets. But I think once you get past COVID, once you get back to quote unquote a normal economic environment, I think there is optimism, but it's not going to be easy. It's not a lot of days you can go onto the live floor and take every opportunity that there is out there. It's going to get harder. You're going to have to try harder to get that opportunity. You're going to have to build internationally. You're going to have to connect to new markets. But there certainly seems to be an increasing willingness to do that.
Well, Will Mitting, on that incredibly optimistic note, I'm inclined to wrap things up, actually, but I want to ask you if there's just one more thing you want to share with us this evening in terms of what you're looking at for 2021, or what's going to be a particularly exciting thing to keep our eyes on.
Well, I think we talked a lot about the industry. Certainly from our perspective, there's two things we're focusing on for the rest of the year. One is we've just built a new data sharing platform that we think has a potential to make significant inroads into operational benchmarking, and we're talking about that with a number of clients with a view to launching the first private benchmark in Q2. So that's exciting for us at the moment. And I think fundamentally the big question we ask, and I know speaking to some of my former colleagues at FOW and friends at FIA, that everyone's asking the same question, is what does the event model post-COVID look like, and how quickly will that come back on stream? And there are a lot of uncertain questions about that, but without a doubt it will come back. Without a doubt it will come back very differently to how it was before.
Well, on that note, and obviously an apocalyptic one, because I'm sure, as we've had many viewers from the exchange-traded derivatives business today, who've all probably not been able to go to a conference for at least a year. So that therefore means that, like me, they've run out of T-shirts at this juncture, because obviously that's one of the things that everybody looked forward to get to the Rat's Mouth Boca Raton in the middle of March for, amongst other things. Will Mitting, thank you very much. It's been really fascinating to hear about the many challenges there are, both on the exchange-traded derivatives side operationally throughout the stack, for brokers, for the proprietary traders. Interesting, as you say, to see how many proprietary traders are now looking towards emerging markets. 3/4 of them, 74%, going off in terms of time. And we have, by the looks of it, a remarkable final question that has come in. So, will we see legislators and regulators develop divergent opinions on who owns the data? And will that impact the revenue of exchanges? Good evening, Martin Watkins. Will.
So, I know who owns the data is almost a philosophical question, and I don't think the regulators will weigh in on that side. Certainly, I think what regulators may do, and this is, I think, the risk that exchanges are certainly fully aware of, and I think need to respond to collectively through potentially one of the associations, is that they will limit how much you can charge. And there's already talk about having a transparency over the cost of your processing of the data, and then a benchmarked increase on how much you as an exchange or a data provider can charge on top of your cost of producing and disseminating that data. So that, I think, is probably the nuclear option, rather than opinions on who owns the data. Obviously, the market thinks it's their data, the exchange thinks because they process it as their data. I don't think the regulators will go down that line, but I do think there's a very, very real risk of draconian action from regulators when it comes to market data that will have serious impact on exchange revenues. And I'm certain that those exchanges that are currently making significant proportions of their revenue from market data are very aware of that.
Very interesting. And also we got one final comment, which is really illuminating. Thank you very much, Will, for that answer. Really super question altogether. Martin Watkins, great to see you as usual. So Jonathan Cowan's back, the latest on ESG investing. He was digging into the motivations, and NNIP found that 97% of Nordic investors viewed it as very important, while climate action, affordable and clean energy, as well as clean water and sanitation were cited as the most important components of the Sustainable Development Goals. That certainly sounds like there's a big ESG future in ETD to me. What do you think, Will?
Yeah, I totally agree with that. I think this is the groundswell is so big, it can't be stopped now. And yeah, I think absolutely it is. It's going to get bigger and bigger.
And it has to be said, that's also bigger and bigger in terms of questions. I feel a bit like Artie Bell at the end of one of those Ronan Martin's laugh-ins in his Cold Scuttle helmet coming over. However, this is anything but very interesting, but stupid. It is very interesting, full stop, this whole ESG debate. Thank you very much, Jonathan Cowan. Thank you to all of our questions today. Thank you, Jonathan Cowan. Thank you, Martin Watkins. Stuart, he gave us a couple of excellent questions throughout the course of time. It was lovely to hear from Danny Corrigan earlier on during the course of the day, and also Tom Lant, amongst others. Several of you were also behind anonymity, so we couldn't manage to tell who you were. Well, that's absolutely perfectly reasonable if you were doing, I suppose, a suitable privacy arrangement for your exchange-traded derivatives. It only remains for me to say thank you very much for watching this live stream. Don't forget, before you log off, hit the like button at the bottom of the page, please, so that we can roar up the interested parts of the search engine pieces that virtually nobody can actually manage to understand. But all we do know is more likes means more popularity. I'll catch you on exchangeinvest.com during the course of the week to all of our great subscribers. Will Mitting's going to catch you at Acuiti.io, and I look forward to discussing some of your future research. Well, it's been absolutely fascinating having you on the show. Thank you very much also to our production team, to Beata, Ola, Claude, and indeed Pippa. It's been a fantastic IPO-VID. This is the conclusion of IPO-VID 016. Have a great week in markets. We'll be back next Tuesday, 1900 CET, 1800 London, 1300 in New York. Thanks for watching.